All right, stock started the week not on the best foot here this week, but quite the intraday move, quite the turnaround in the rally. So I'm going to break that down. Why did we get such a big move from what was a real significant low point and pretty heavy selling, albeit mostly overnight, but pretty heavy selling here early on in the day? Why did we fill in that gap with such ferocity today? So I'm going to break that down, put it in context of the selling we saw last week, and then what's really driving, what was so bearish at the beginning of the day, what rallied the most by the end of the day, so what's driving this price action. We'll take a look at a sector rotation as well, and then we're going to take a look at a really popular stock. In fact, the biggest stock out there by market cap, and look at the move it's making and talk about how we might be able to trade it with a trending move potentially developing. So we'll talk about that. Let's go ahead and get started. Today is Monday, January the 10th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off taking a look at the market forecast with the on the S&P 500. Look at that long lower shadow we got today. We'll talk about this more in just a minute, but it was interesting that we had as big of a close or big of an open today, and at the lows of the day. We'll talk about why we rallied up so much here in just a second. But in terms of the market forecast, light pink shading and now yellow line, because the moving average is actually higher, even if we're below it right now. The intermediate line is falling, but still in bullish territory, so very weak, bearish posture there. And then your short-term sentiment line is also improved, but just barely to the top of the bearish territory. So that's hardly an improvement at all. But at least it's better than, a long lower shadow is better than nothing, especially when you've had a little bit of a decline. It's not much of a decline there, so it's not much of a trend to reverse. But long lower shadows are typically really, really bullish patterns. If you take a look at the NASDAQ 100, we also got a long lower shadow. We got more of a body because we gapped down more at the open. We're still 3% below the moving average. In fact, we actually just barely closed higher. The S&P barely closed lower, so just a smidgen higher on the NASDAQ, but still, like I said, 3% below the 30-day moving average, so hardly bullish in that perspective. But long lower shadow nonetheless. Russell 2000, same thing, long lower shadow. Very good sign there. The short-term sentiment did not bounce up as much, and we're still 2% below the moving average because we're still down today, and actually closed below all these low points, even with the rally that we had. So very interesting day from that perspective on the Russell and the S&P and the NASDAQ. You can see the intermediate line crossed back down below the market sentiment line for the first time. It's actually now below 40 barely, and the market sentiment line is almost below 40. So we're that close to getting market sentiment into bearish territory in the Russell, which we never did do during any of these little drops here. But this one's been a little bit more significant. Again, fake outs tend to be a lot more bearish than just the resistance holding in the first place. So you can kind of get an idea of how things are going. I'll talk a little bit about more of my expectations here in just a second as we look at some more of these charts. If you take a look at the S&P 500's chart here, you can see we got a bearish candle. So we have a negative differential, falling PPO. We're very, very close to a red arrow on this line. 46.57 is where the line's at, and we're trading at 46.70. Of course, the low today was down to 45.82. Excuse me, on the regular candle, the low was 45.82.24. So we were actually below the Hakinyashi, the 10-week moving average before climbing up at the end. So again, that's how close we are to kind of getting the bearish pattern here that we already still have on the Russell. In fact, the Russell 2000 now, the Hakinyashi candle is bearish, falling PPO, and for only the second time or third time in a while, we closed below. In fact, this is the lowest Hakinyashi close. We're only a day into the week, so the week's not over with. But as of right now, this would be the lowest Hakinyashi close since, below the 40-week exponential moving average, which is our, on this case, on this chart, our proxy for the 200-day. We do have a red arrow on the NASDAQ. It's a very bearish candle there, pretty decently low differential. In fact, it's the lowest differential. In other words, the biggest body that we've had on a bearish candle since back here in February. So it kind of gives you an idea of just how how bearish we are. We're more bearish now than we were over here in September and October, just because of the size of that candle. They tend to get, obviously when you're in more significant declines, the differential can get a much lower. You can kind of get an idea of, outside of that, if I were to go back to some other more bearish declines that we had, like in the NASDAQ in the fourth quarter of 2018, first quarter of 2018, and then going back to 2016, to kind of give you an idea about where my horizontal line here, about 4%, is where the differential is, the size of the differential. You can see we got bigger, the candles got bigger in each of those instances. And as of right now, we'll see if that ends up being the case here. The PPO right now is higher than any of those other instances. So there's opportunity for us to be bearish for a while here, more so than any of these other cases. We were very similarly high, similar levels back in the fourth quarter of 2018 for the PPO. But keep in mind, too, that we've been converging for so long. So very similar to this very long convergence we had over here, and then things got volatile at the end of 15, beginning of 16. Remember, over here is back when the Fed was normalizing policy, right? They raised interest rates for the first time in the end of 2000, or December of 15. They raised another 25 basis points in the fourth quarter of 16. So we had already tapered. They had not started to lower the balance sheet. That didn't start until over here in 2018. But it does kind of give you an idea of how the market responded with some volatility pretty much at each step that the Fed started to normalize policy. And also keep in mind that they're pretty much truncating all three of those steps into the next few months, over the course of the next few months here. So we'll see how that impacts what had been a very, very high PPO that has been converging for a very, very long time. Will it ultimately make a run towards zero again, which it did in each of these instances? That's the big question mark, right? If you take a look at the Russell 2000, you remember again, we already got, we're already below, like I said, that 40-week, and look how long that PPO has been diverging, and we're pretty close to getting a crossover there. And you can also see too, how big those bearish candles get when things get more bearish than your typical intermediate decline. Let's take a look at the 3 green arrow charts, and you can see we got 3 red arrows here, 3 red arrows, 3 red arrows, and 2 red arrows. So we're still above the diamonds are still above the moving average, even if everything else. And now you also notice that like the Qs have been red, the pink shading here, for 4 consecutive days, right? It's one thing to only have it for one day and then you bounce, but now we're getting multiple days, 2 days on the S&P, 3 days on the Russell 2000, and now 4 days in the Q. So another sign that this is probably not going to be short-lived. Now this is what I wanted to talk about. So at the lows of the day today, you can see that here. Let me bring this up over here. I'm going to bring up another indicator down at the bottom. This PPO indicator. Here we go. And I'm going to bring up how far away we are from the 8-day moving average. So you can see, we finished the day down here at, about 0.89% below the 8-day moving average. Now, at the lows of the day, that's a different story. At the lows of the day, 456.60 divided by where the 8-day moving average is at today, 469.68. At the lows of the day, we were almost 3%. And to kind of give you an idea, 2.78%, where that's at. I'm going to change this, 2.78%. Is that right? Yep, 2.78%. I'll show you kind of where that's at there. So, and let me zoom out so you can get some perspective on just how deep that was. Okay. So you can see like all during this time, only over here in late October did we get that low, and the same thing over here in September. And you can see every other time we got this low, we came right back up to the 8-day, right? It's hard to stay, more further below the 8-day moving average than where we were at today at the lows. We did get lower during the COVID drop, not surprising, right? But then before that, look at me, even over here, like even that was an aberration because it was, kind of like this trade deal, the issues that we were having in December, and there was, the administration, the president at the time would tweet out his personal thoughts on the trade discussions, and that really had an impact on and investor sentiment, and things really dovetailed at the going into the Christmas of 18. You can see how quickly it reversed. It wasn't that big of a deal. But you can even see getting lower than 2.78 was even an aberration there. And then every other time, we got significantly below the 8-day, we jumped up. We got below it, we jumped up. And so here, instead of getting that far below it by the end of the day today, we jumped up during the day today. And now we're still not there, right? We're still only 0.89. So I still think that there's actually more of a rally to come. We may very well rally overnight or early in the morning to get back up, but I don't expect that. In fact, I actually don't expect there to be much of a rally because of the 50 and the 30-day being above us still. But even then, like we've been below the 17-day now four days straight. We're, in my opinion, starting a bearish divergence. We skipped the bullish convergence because we went straight from being above it, the MACD being above its moving average, to being below it at the same time that the price crossed below the 17-day. So we went from, this is a bullish convergence where the MACD is below its moving average, but we're still above the 17-day moving average. We never had that here. We went straight below the 17-day immediately and have been for 4 days. And today's move off of the low was simply, in my opinion, just to move back to the 8-day moving average because you were so far below it. So over here we're 2%, but at the lows of the day today, you were 369.31 divided by where we were at 387.64. You were 4.7% below at the lows of the day today, the 8-day moving average. Let me give you an idea of how far back down that is. Minus 4 point, how much did I say? 4.73. Sorry. 4.73. So you can see where that's at. Like that's how far down below we were the 8-day moving average at the lows of the day today. That's pretty darn significant. Again, only COVID was lower, and every time we get this low, we come right back to the 8-day. So that's essentially what happened today when we got as low as we did. Below the 8-day, we get your biggest bullish moves when you're the furthest away below the 8-day moving average, and we got that today on an intraday basis, right? In fact, today's move on an intraday basis, to kind of give you an idea, we went from the high of 380.64 and the low of 369.31. That's a over 3% move on an intraday basis. So once we were that far, this blue line down here, once we were that far below the 8-day, then we had this is on the Qs. So let me pull up the Qs here. Once we got that far below, we had a 3% plus move on an intraday basis. And we only had, you can see it's a very small green bar there, but the reality is on an intraday basis, it was like up here. It was a huge move to the upside. That's not surprising, right? We had some big moves to the downside. We got so far away from the 8-day that we rallied that far. And we gapped significantly lower. Look how much we gapped today. We filled in the entire gap and went up to the upside. So that's kind of why I think that we rallied so much. You can see the negative index on the DMI is well up above 25, so we are in bearish mode there. So is the Qs, well up above 30, almost up to 35, and you can see an IWM also well above 25 up to 30. So the DM and the positive on IWM is below 20 now. The Qs is also below 20. So these are significant breakout patterns with the ADX pretty darn low, like set for a breakout move. So again, and below 20 on IWM too. So you're getting breakout patterns with the ADX rising up at low levels with chances for new moves to begin. If you look at the Ichimoku cloud, obviously you're still kind of flirting with the cloud and just ending a bullish move on SPY. But if you look at QQQ, we're starting, we've been relatively noisy. We're flirting with getting below the cloud there. IWM, we already are below the cloud, and we're below the blue line and below the green line, and potentially, and we're still haven't even started a bearish trend here. You look at the RSI and the CCI for SPX, you can see kind of what it's trying to do, trying to get into bearish territory. You look at the Russell, you are flirting with bearish territory. You look at the NASDAQ 100, you are in bearish territory on all these different indicators. Looking at the Bollinger Bands, you can see we are flirting with the low end in this middle, which is this neutral area. We're at the low end of that neutral area. On the Qs, we are in the lowest quartile, pushing down on that lower band. And IWM, we are also in the lowest quartile, pushing down on that lower band. So and really pushing against the low end of the 1 year value area. So as we've talked about before, you're entering an area potentially entering an area of volume, a gap that there's not a lot of room to go down into before we get down into that area, and not a lot of support holding you up until you get down to this 188, 187 level. So all these oscillators kind of telling us that things are getting, it doesn't look like this is like the end of a move. It's more and more looking like we are starting some bearishness that ultimately will end up being relatively, that ultimately will end up being more of a market sentiment decline. You can see we filled in the gap today. So what that's done is probably whatever bullish move we would have had yesterday probably got pulled forward to now. And we might gap up a little bit tomorrow. Again, more closer to those 8-day moving averages before resuming the trend that we're starting to see develop on a lot of these different indicators. IWM, same thing. We're in the lower half of the chart, just filling in the gap. And then the Q, same thing. We're in the lower half of the chart. We got a new 4-week low, so we got a new bearish crossover on the Arun indicator on the Qs. So it's a bearish move here, and now we filled in the gap. So whatever bullish move we would have had tomorrow to fill in the gap from today, we've already had. Whatever bullish move we would have had tomorrow to get us back towards the 8-day moving average, we had today. The big time bullish move we would have had tomorrow, that would have been 3% plus move, we had today. We just had it on a intraday basis today. If you take a look at today's volume, you saw it was pretty significant. It was above average, 119 million. The range was 9 points. So when you put those numbers in context, 9 points is well up above the average. So it's but still, it's just at the 2% mark. Remember, intermediate declines typically end when you get closer to 2% on this ratio. So there's on one day doesn't get you there by itself, and then you can see the volume is above the average, bringing those lines up. When those lines move up, remember, that's not necessarily the most bullish. And then you look at the volatility. The volatility ramped up to 90%. It hit resistance at 90% mark. Now it's pulled back down to support at the 85% mark. What it does here will be really important in terms of how bearish, how quickly we'll be bearish. Whether or not we spend some time here in the lower half of the chart. When you look at the VIX on this 2-line basis, we got, there was a very big long upper shadow, but you see like we had broken up above the 200-day moving average back over here, a few days ago, last Wednesday, and we stayed up above it Thursday and Friday, and we're still up above the 8 and the 17 and the 200-day moving averages, and flirting with getting above the 50 and the 30-day too. So volatility is still relatively high. Like, we're not breaking back down here to where we can stay bullish on a relative basis, nor here on an absolute basis either. So again, I think the bullishness that we would have gotten tomorrow or Wednesday, we just got today on an intraday basis. So we may get a little bit more follow through to try to get us closer to the 8-day moving average. But until we're back above the 17-day moving average on a lot of these indexes, like SPY for an example, until we get back above the 17-day moving average, then I expect that we are still in bearish divergence mode. And when you're in bearish divergence mode, that doesn't mean you go down every day. Especially the further away you get from the 8-day, you're going to pull back up to it. Right? The question is, how long are we going to be in divergence mode to where the 8-day moves down away from the 17-day? That makes it harder to switch back to bullish divergence mode. That's the big question, and I think that's going to take some time over the course of the next so many weeks. But I definitely do not think today, is a reversal. I think today is we were so far down and we gapped down and we went so far down to lows today that instead of staying down by the end of the day today and getting that big, huge gap fill and big, huge move tomorrow, we already got it today. And I don't expect a lot of follow through from that going into the rest of the week. In fact, now I expect that we'll start to fill in most of today's range, if not go further lower to a lower low, if you can see again on the SPY. So this is this week, right? So this week, this would be the high for the week, which is slightly higher than last week's low. Now the question is, are we going to finish below last week's low? And I fully expect that we will by the time all is said and done down in this area. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Why you expect, what charts are you looking at that suggests why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked the video today. You want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have on anything that I brought up? Join our website at marketscholars.com. There's a link popping out up there on the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Click on this icon. That takes you to our Market Outlook live page. Here you can see all of our Market Outlook live videos. I do these Monday, Wednesday, and Fridays at 3:30 Eastern Time on this page. That's how you can also get to it by clicking on Market Outlook Live Trade Review right there. I review all the trades that we've done in the old Market Outlook videos to see whether we should stay in them or get out of them. We actually moved one today that I've done earlier video. We closed it out and reversed it. So that we talked about that in today's video. We also put on today's trade before the market closed. So that you see at the end of the video. We already put that on today here. So that's there. If you come down, you can see our upcoming classes. Click on View More. It takes you to our calendar. You can also get to it here by clicking on Trading Rooms. Here's all of our upcoming classes as well as all of our recordings going back over 3 years. Come down to the bottom, click on this heart. It opens up this page. Click on that like button. Click on this thumbs up icon. Takes you to this tab. Hit that like button. Again, the more you do that, it helps get our content out to more of our followers. The more engagements these have, the more people the content reaches. That's how their algorithms work. That's why we always ask. Also, it also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching. All right, now let's talk about what's driving the price action today, and let's look at what happened here today at the beginning of the day and then by the time we finished. So by the beginning of the day, you can see the Qs were down 2.5% or more. IWM again down 2%. I mean, it was a U.S. equity sell-off. Developed markets sold off. Emerging markets held up very well at the beginning of the day, along with commodities. You can see the dollar was strong. It didn't put pressure on emerging markets. It put pressure on a lot of other equities, but not on the emerging markets. Gold was down. Long-term bonds were down. But by the end of the day, everything rallied. Gold rallied. The dollar stayed flat. Gold rallied. Rallied. Long-term bonds rallied. Qs rallied significantly. Look at off. I mean, there again, there's your 3% move off of the lows. Small cap stocks also rallied. They'll finish with a loss. Large cap stocks dropped. Emerging markets actually were held up pretty well. Ended up with the biggest loss, and then emerging markets were also slightly positive by the time. So very fascinating move. Let's put this move in context of the selling that we've seen over the last so many days. So it really kind of started here on the 5th. Let's see, when did we have the big sell-off? So yeah, it was starting here on the 5th of this calendar year. So this basically Wednesday. So if I were to go back over here to the 5th, so it's pretty much these last 4 days to kind of see how the selling that we had on Wednesday and that continued through the end of the week. This is what happened. I mean, again, we were down almost 6-7% at the lows today, and then we've now come back up to a 4% loss, and small caps also up to a 4% loss, and large caps up to a 2.5% loss, and so you can kind of see how, okay, like what had really sold off, this has rebounded here in the short term, and that was pretty much it. Let's look at all those developed markets and our major emerging markets here. Again, you can see China bouncing up this moving average, Russia, South Korea. India is the only one really that's significantly above its moving average, along with the UK from a developed market standpoint. Everything else still bearish, still downward declining. Italy is above its moving average. Germany has pulled back to its moving average. France has pulled back to its moving average. They're all above their moving averages down these developed markets, along with the U.S. But again, pulling back down towards them. If you take a look at the sectors and how they performed over here, especially this just today. So let's go look at just today here. You can see at the beginning of the day, XOK, XLY, XLC. I mean, these are QQQs, and by the end of the day, XOK was higher. XLY and XLC kind of moved higher too, but didn't finish as strong. Healthcare finished up 1% today, interestingly enough. And on the other end of the spectrum, all these cyclical areas, energy, financials, materials, industrials, they all kind of lagged the market by the end of the day. Materials and industrials were your biggest losers here. And again, going back to that 1-5 time frame, again, you can see how far down XOK and XLY were. And they're still down, 5-4%. Energy and financials are still up quite significantly. So again, today's intraday move, wasn't necessarily kind of a trend-changing move. It was more of these areas were really down over a short amount of time, 7%, and now they're still down significantly, but now just not down as much. So they're just recovering, what was a pretty relatively sharp sell-off over 3+ days, including today's opening move, overnight move, and then by early morning here. Let's take a look at some of these charts on these different asset classes. We saw TLT, had been giving some overbought clusters. The histogram has bottomed out, which means the MACD is bottoming out soon. The MACD bottoms out like it did here, then expect, a little bit of a rally in bonds. I expect that we'll get another rally in bonds, very similar to what we saw coming off of those October low points there. The dollar was also a kind of a mover today and still in convergence mode and hasn't really started the bearish divergence. But you can see like the Euro US dollar is trying to figure out whether it's going to break out to the upside or break out to the downside. And if it does go to the upside, there's a huge gap up to the 200-day moving average before it gets there. Looking at the commodity index, right, and you can see the high point that's forming here. The MACD, the histogram has already peaked. The MACD looks like it's peaking. So I expect we'll get some weakness in the commodity space. Bitcoin has been something we've been keeping an eye on. You can see it's also well below its 8-day, well below its 200-day moving average, and we're working towards one of those death cross situations. Even if we are still diverging, there's a higher low point here. We're in this bearish divergence right now, down away from the 17-day, but it doesn't look like the histogram looks like it's already bottomed out, which means that we might be bottoming out here, at least for a move back to the 17, if not the 30-day moving averages, and then we'll see if we get anything more than that. Remember, this is a reflection of risk appetite on the far end of the risk appetite scale. Same thing with ARK, which is so far below its moving average, especially the 8-day, that I think right now what you're getting is, a move back up here to the upside. All right, now let's transition to our trade idea of the day, and let's take a look at Apple. Apple, you can see its intermediate line's lower than it has been this whole rally. Obviously, a little bit of a higher high with a slightly lower high in the intermediate line. Dropping below the moving average today, filling in the gap up to it. So an improved short-term sentiment that was pretty heavily oversold. Again, another idea behind why we rallied today is because you had some very oversold short-term sentiment. Now it's still bearish, but not as oversold anymore. And then your intermediate line crossing down below its market sentiment, which again, it did not do here, and now it is. So you can kind of see last time it fell below the market sentiment over here a couple of times, and then finally over here where it got below the moving average as well as getting below market sentiment, which is kind of what we're seeing right now. So you can also see too on the long-term chart, getting a bearish candle on its Hakinyashi. You've got a falling PPO at a relatively high level, 12%. You got a bearish differential here. You got a bearish candle coming after a transition. I mean, we were flirting with a red arrow here at the lows of the day on this chart. So bearish candles from that perspective. If you take a look at the 2-line version of this chart, you can see the MACD and stochastics. You can see the MACD is just barely above. It was actually below zero when we were looking at this for the trade. You can see the stochastics moving down. So you can see how we were in this bullish convergence mode. The MACD was below its moving average, but we still stayed above the 17 that entire time. But you see this big change in direction where we went from bullish convergence to now bearish divergence with the MACD histogram really moving. That's what happens when you fall below the 17-day. Again, something similar over here. And then we kind of moved our way back up. After breaking down, we moved our way back up to the 8-day, but then extended away with a new bearish divergence move as the MACD got below zero, and that's kind of what I'm looking for here as well, especially with very little volume support below. You got to move down to the 50, but below that, your 200-day, probably by the time you get to January expiration, your 200 days is going to be right up in this area, right where the point of control is. At the very top of the value area. So that kind of gives you an idea of how much room there is that the stock can move in with very little support in there. Obviously, there's going to be some Fibonacci support from this intermediate run down into this area, but that low point, the 62% retracement is down into this spot right about 155. So again, very little support through that Fibonacci retracement area. Obviously, looking at some of the these other oscillators, you had such a big bullish move. Your ADX is still very high, so a bearish crossover here will most likely not produce a weak bearish move, but more of a bigger bearish move because it's still really high. Unlike this one, when you finally got the bearish crossover after the ADX had fallen, now you're getting a bearish crossover with the ADX still very, very high at that level. From an RSI and CCI standpoint, you can see they're flirting with the bearish levels on those areas. From the Ichimoku cloud, we are still got some gap here until we get to the cloud. You can see that 62% retracement is through the cloud. Now we do not have a strong bullish pattern anymore. Remember, the ADX is still really high, so we've ended the bullish trend that we had, and now we are kind of flirting with dropping into the lower half of this chart. Again, very similar to what we saw over here, getting into the lower half of the bandwidth and then potentially pushing down into the lower quartile of the bandwidth if we start to trend lower. So what I decided to do there on this trade was to come over and sell the 170 call option. So you can see it right here. Sell the 170 call option. So it was at the money. It was at the money at the time. So sell the at the money call option. Buy the next one up, the 175. So what that did is, and go for a full position size here. Of course, typically in short vertical spreads, we're willing to lose what we're trying to make. In this case, trying to make 960, which means I could pretty much lose 960 or pretty much almost all of what I'm putting at risk, a normal position size. But the reality is I'm not going to try to make 960. On a bear call spread, when stocks fall, they can fall pretty quickly, and we can get 50% of max gain pretty quickly. So the reality is I'm actually going for about a $480 gain here, if I can get it rapidly, quickly, before we get to that 20-day mark before expiration. If I can get to 480 here within the next so many days, then that means I'm only willing to lose 480 out of this 1,000. So if Apple does keep going up tomorrow and we get to the point where I'm down $480, it would take a move all the way up to about 181 in that area for that to happen. So we'd have to really shift course here and make a move all the way back up. Let's see, let's go over here. we'd have to make a move all the way back up to 181. So we'd really be shifting course and well back up above the 17-day. So I'd be more than willing to I mean, that's not going to happen on a whim. I'll take a loss in that point. But if this is as far as we get, then we might be able to get to the 50%. I mean, should just getting back down to 160 right now would be, or is it 160? Yeah, 160. The lowest today was at 168. So we might be able to get that tomorrow, or then within the next few days we can get down to that area and get that 50% of max gain, and then be done with the trade at that point. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, as well as our website at marketscholars.com. Click that thumbs up icon. Like us on Facebook and Twitter as well. Comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.